only 3% of the market right now. So I
Yeah.
focus on what I do know. and
Yeah.
and what I know about FHA is just how much, I mean, they're over 12% delinquent. That's 7.9 million loans. So if you look
Wow.
at that, that's about a million loans in some sort of delinquency. And now here's the bombshell that through a colleague of mine, we realized when I got back from the conference is that you can't, you're not eligible for an FHA loss mitigation solution if you have delinquent student loans. The way, so that, so
So let's
what,
break that down a little bit,
yeah, yeah.
right? So what is the percentage of people with FHA loans right now? They're young.
So I don't have the
Guesstimate.
exact, but I can tell you how many have student loans.
Yeah.
So I don't have the age breakdown,
Yeah.
but in 2021, HUD came out and said they had 45% of their borrowers had student loans.
Yeah.
45%. And I can tell
Wow.
you that was 21. What has happened is FHA just started giving out loans like candy through the,
Hmm.
and to your point at the beginning of this conversation, I think there was a lot of election year politicking to keep everything just going like this, right?
Absolutely. Yep.
And so that's why we haven't seen the distress because it was April of last year that they came out with this crazy program that said, we're just going to keep cutting you a check, cutting you a check, cutting you a
Yep.
check. You're 3 months behind. Okay, here's a
Hmm.
check. Another
Yeah.
three. Okay, here's another one.
Yeah.
So, but so here we are. So I'm going to say it again because it's so important. And I'm trying to find out from the servicers how this is all going to work because this
So if they
isn't,
have a student loan that they've in the past defaulted on or is it currently defaulted? Which one is it?
it's currently delinquent.
Delinquent of any fashion, they will not do any workout or even have a conversation to work out with that borrower at all.
Well, they'll have a conversation, but the borrower won't be eligible. And so there's 9 million student loans right now that are in some stage of delinquency.
Hmm.
So let's take our FHA, 1 million potential for loss mitigation. So we know that student loans are at a 20% delinquency rate right now. And so just with this alone, you could have in late Q3, really Q4, probably.
Okay.
Well, this is what I'm trying to get clarified right now because this is an old
Hmm.
requirement, and the
Hmm.
way we think they got away with it is that these loans weren't being reported to this Kyver system, which
Okay.
is like the federal debt. You check it and say, okay, who has federal debt? Do they have tax debt? Do they have this debt? Because that makes you ineligible. We think all of that reporting to Kyvers was shut off. And so I'm trying to find out from servicers right now. And if anybody listening to me knows, I want to hear, I'll have an answer in a couple of days. One servicer I talked to thought this wouldn't be implemented until October. And I said, no, this is an old requirement. So they're getting clarification. But that could mean like 90,000 folks, like just boom, overnight, are going to
Hmm.
be ineligible for a loss mitigation. But that's not even the worst part. My friend, colleague John Comiskey, he loads every month the Ginnie Mae data and based on looking at and putting together life of loan kind of snapshots, there's between 200 to 500,000 of these folks who have gotten repeat partial claims, repeat workouts, which means
Hmm.
as of October, they have no other option. No, not for 2 years, and nobody out there with an FHA loan has 2 years. That was 2 years ago.
Hmm.
So you're talking about in Q4, Q1, it could potentially anywhere from 200 to 500,000 like folks foreclosures hitting.
Hmm.
So it is,
Wow.
and so my friend John and I, he's working on the numbers in the back end. But this is just the stats, this is, and so we have to like looking at this data tells me everything I need to know. And then what I also know is that the Fannie Freddie books are much weaker than anybody believes because of this credit score issue. And we're seeing all over social media people say, I got a call from my bank overnight. My credit score went down. We'll be starting to hear about credit cards being canceled, home equities being frozen, I mean, this is what's going to, because these all the home equities have a credit score trigger.
Hmm.
And I remember having a conversation a year ago with someone who wanted to get into home equity, and they were like, "Well, it won't be a big deal." I'm like, "Oh no, no, no! You want that credit score trigger?" So overnight, you've got servicers waking up to, "Oh my God, like what is happening?" I mean, so it's they were already starting to come around I'd say in October of last year, had conversations with them. They weren't as interested right now. They are definitely understand that distress is here and the default cycle has begun.
So
Mm.
Sohal commented Caivrs. He's a
Yeah,
servicer.
Kivers. Yeah.
Yes. So
That's
that's just
Skyverse.
yeah.
So the question there that he had was how delinquent, like when we're talking about
It's
delinquencies,
yeah, so I it's delinquent at all from the understanding of
even
just
30
the
days.
yeah, so once you hit that, and that's, guys, if you don't know, when you hit
Yeah.
that 30, that's when it goes to your credit score. And
Yep.
so this is so huge. I still can't even believe it. That's why I'm talking to servicers to see how this is going to be enacted. And if they thought this wasn't a requirement, that's going to be very fascinating. So, yeah, you're just seeing it's gradually and then suddenly, that's the old quote. And right now, what's happening, and you can see it in retail sales. Yes, we had some front running with the tariffs, people buying cars
Yep.
but if you exclude the autos, you can see retail sales are down. So our top 20% is pulling back on spending. Travel is looking
Hmm.
very weak for the summer.
Hmm.
Um,
Okay.
so every all signs at the moment, people watch the stock market to understand the health of the economy. That has remember when we were in the depths of COVID, the stock market was mooning, right?
Yep.
So it is not that is not a reflection. That is a casino
Yeah.
and it
So let's
operates as such.
so
So
Yeah.
what are you seeing in the servicer world? Because that's some data that no one can touch on delinquencies, right? Have you talked to some of the bigger servicers out there to get an idea of what is performing, what's not performing, percentage of performing? What have you been hearing through the whispers?
well, I mean, honestly, I just use my client books, so I don't even have to. I mean, so I'm hearing stuff, David, and for the longest time, nobody was interested in talking to me. Like when I ask, "How's your delinquency?" Like da 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 da. I'm hearing stuff, and I had a conversation with a very large servicer last week or 2 weeks ago, maybe right before I came to your conference. Time has
Hmm.
I don't even know what day it is. Okay, that they were concerned that it was the change in tone. And honestly, the shutting down early of that FHA loss mitigation program, and we kind of glossed over that, but what the administration did was they shut down this program and they put a limit on it that you can only get one of these every 2 years. And that program will expire at the end of September. So there still be loss mitigation, don't get me wrong, but this was so over the top. And by the way, a lot of FHA has already used their workouts, and so they're going to foreclosure sell. If you just look at the level that Black Knight reports of foreclosures, we're actually at January of 2007 levels. And so they won't say that in the report, but
Hmm.
if you just have the historical information. So there's just been a lot of gaslighting, a lot of glossing over what's really going on in the hope. And who knows? I mainly because hope is awesome, right? Like keep hope
Yep.
alive. But most people have just missed how much speculation there is in housing because you look at our demographics, people that are talking about a shortage really aren't digging in to understand what drove all of this crazy price appreciation. And it was just speculation. It was not
Hmm.
first time home buyers trying to get a
Hmm.
home.
I'm trying to
Right.
look into seeing what Case Schuler's saying now about
Oh,
values versus, home income, because that was a big thing back in the boom, and pulling that data and seeing where nationwide where that looks
I
like.
I have that slide. If we want to do
Yeah.
that, let me just get it up here for you,
Yeah,
David.
no problem.
Because to me, because I'm a data nerd, I had to do this for myself. I had to pull it myself, and I encourage that because it changes what you're kind of, how you understand the data. So let me just get this. Okay.
No problem.
All right. So, oh, and the other thing that I will say is we basically are at debt to income levels in the Fannie Freddie book that same as we were late 2007 as well.
Okay.
So
Wow.
you're seeing it in the debt to income as well. So let me just share my screen. Can you see that
Yeah.
or?
Now, yep. There we
Coming
go.
up. Here we go.
Okay, so this is just about our labor force. I'm looking for that slide for you. This is we have more part-time job holders that where their primary and secondary jobs are part-time than we've had since this started in 1994. These are the debt DTI levels I was telling you about. The Fannie Mae, I call that the jaws. You see how those jaws
Yeah.
are about to close. And
Yeah.
then let's see, where is my? So here's mortgage rates, home price. Here we go. Okay, so this is a historical perspective. On the left, you have that's existing home prices and incomes. And you can see we're at the highest level of unaffordability. This series goes back to 1999. That's existing home prices. So that little ratio, that little line, not the bars, is so the blue is going to be your household median income. And you can see that's really hasn't grown all that much, right,
No.
guys?
Yeah. Yeah.
And then you see the median home price that's grown a lot, and
Yeah.
then you kind of see that ratio, like we're at the highest levels we've ever seen since 1999, because that's all I have from NAR. You go over to the new home price over here to the right schedule, and again you see incomes and you see new home prices, which have
Hmm.
really started to come down, new home prices, and so that's why this looks a little bit better. And that's what's really interesting. We just had existing home prices come in $100 more than new home prices, and so when that happens, historically, it flips the next month because
Okay.
you really shouldn't have. I think I have that chart, but that's okay. Oh yeah, so here, uh, new plus existing medium home price. You can see how the red is the new home median price, and you can see the blue is median for existing. Uh, this is historically new homes are always more expensive, but because
Hmm.
of all of the buy downs and
Yep.
everything else, and by the way, they're not even properly capturing the buy downs and the concessions in that top line price. But you've got a new home market that is completely oversupplied with highest number of inventory since 2009, and nobody's buying. So, but I can stop sharing now, unless,
Yeah.
yeah, okay,
No.
Interesting.
yeah,
Hmm.
Amazing. We've heard things such as 17% defaults. We've heard 20. We've heard up to 30% defaults in some of these things. Um, it is nerve-wracking to see that we're kind of in a different world than we were '06, but I don't know how it's going to stop, right? And there's what, $30 billion of seller finance paper created annually, and that's not even discussed in any of these numbers, and sometimes not even tracked. Like we said at DME, sometimes those things are privately held and privately serviced, so you couldn't even tell what's happening. We're talking to some of our colleagues in the space, and some are grabbing notes that haven't been paid in 10 years,
yes.
right? And handling those kind of things, those are things that are not tracked anywhere. And okay, how much does 30